All right, hi there. I am Mark Sebastian. I am the founder of OptionPit.com, and this is the Option Pit monthly webinar, Options Trading for Stock Traders, Basics of Stock Replacement, and Long Options. So before we get going, let me talk about my favorite subject, which is me. There's nothing I like more than me. That is me. That's me talking to my friend Liz. And I was a floor trader for about a decade. After I left the floor, I founded Option Pit. Now, what does Option Pit do? We are an education and consulting firm. On the consulting side, we'll work with hedge funds, money managers, and asset managers and help them with strategy implementation, strategy testing, and strategy optimization. So I'll go into a large fund and I'll help them optimize their option strategies. I work with a lot of money managers helping them implement things like covered call strategies, cash secured put strategies, things like that. And then we also do stress testing. You know, where can we get really beat, and where can we get where are we going to make the most money? So that type of testing. On the retail level, on the mentoring level, we work with individuals and really institutions in that level as well, teaching them how professionals trade options. We take the professional training course that I went through and some of the professional experience I have, and we try and flip that around and apply it to your average retail trader. So I like to joke, I've got clients that have $1,500, and I have clients that have managed $15 billion. The scary thing is that the guy with $1,500 usually knows more about options than the guy with $15 billion. Not always. In addition to running Option Pit, I manage a hedge fund called Carmen Line Capital, and that is the two hats that I wear. I'm a hedge fund manager and I run Option Pit. So what are we going to cover? Why we use options, some basics of calls and puts, understanding how stocks and options are related. We're going to discuss leverage and the building of a position. And I'm going to talk about how to build a stock replacement play. That puts money in your pocket. And if we have time, which we will, I'll spend a little time scanning for some stocks. I'll show you how I build a trade around some trades that you guys might like. And at the end, I'll save some time for questions. So the power of leverage, all right? Leverage, when used properly, can propel profits into the sky, all right? When used poorly, it leads to doom eventually, all right? Options are a tool to lever when executed properly and smartly, and that is what I'm here to talk about. So leverage and the margin for error, all right? Options can allow the trader to express a directional opinion without a large capital outlay. Option trades allow the trader to carry a limited amount of risk while expressing a directional opinion, and options provide a time component for a trade to work out. Trades can be set up for slippage, and that is the real key. So now let's just talk about the call, all right? And I will take a moment every now and again to answer questions. If you wait until I say any questions, then ask away and have them loaded up and then do send all or send. A call is the right to purchase a security at or before a given date for a given price. So that security could be oil, gold, Apple, the S&P 500, weather. There are securities on weather. There are options that trade on energy tax credits. So they trade across everything. All right. The call is the right to purchase that security before a given date for a given price. For instance, an XYZ, the ubiquitous XYZ, January 50 call gives the holder the right to buy, but not the requirement to buy, the stock XYZ for $50 up until January expiration. Well, we're having February expiration this week, so it's about a 10-month time frame to next January. And so you'd have 10 months for XYZ to settle above $50 and to take delivery if you want. In order to get this obligation, the trader pays a premium for the rights expressed above. This is the trading price of the option. All right, so here's an example. All right, this is Goldman Sachs. This is a real company. So the Goldman Sachs 150, January 2017, 150 calls. You can see the stock's trading 150.94. And at a strike price of $150, so 94 cents away from the strike price, 94 cents in the money, I would have to pay about $16.65 for that option. Nothing crazy there, right? That is a call option. Plain and simple. This is how a long call pays out. Right? You can see that the underlying, this blue line represents stock, and the red line represents the call price at expiration. You pay a premium, but the most I can lose is that premium. And if the underlying rallies, well, then I participate. See? Participation, floor. Love me a floor. Any questions on calls? Does everyone understand? All right. Let me just quickly show you how a call can progress. So let's just look at March weeklies, a call. There you go. And what I want you to notice is how the call's value can change with time and how there is this concept of slippage. All right. You see that? Over time, when you first buy the call, it moves very tightly with the underlying. Over time, that changes around the money. Does the cost of a call get added to the entry to get in a profit? Yes. So when you buy a call, that first, whatever you pay for it, that is, that is a part of your sunk cost, and we'll discuss the payout on it shortly. All right. But if you exercise the call, it does get added in. So if you pay $2 for a call, and then you exercise the call, then so if I bought that XYZ 50 call for $2, I really need my break even. You can see that break even is gonna, let's say this is $2. So here's -2, and then our break even is here. So even though this might be the 50 call, my break even is going to be 52 at expiration. A put is the right to sell a security at or before a given date for a given price. An XYZ Jan 50 put gives the holder the right, but not the obligation, to sell XYZ at $50 up until January expiration. In order to get this obligation, the trader pays a premium for the rights expressed above. This is the trading price of that put option. And you can see here is Goldman again. You can see stock still 150.94. And you see my theoretical value on that put, $17.15. Well, when I buy, for the right but not the obligation. That's important. Oh, and you're right. Somebody said it should say right, not obligation. That's correct. So I'm a man of the people, and I will update it right now so that when you guys say, Mark, can I get these slides? It's already done. So you can see, it's the right, not the obligation. All right. So there you go. Pretty simple. Pretty easy. Can I explain theoretical price? I will, but at a later time. Now, this is the long put. You can see long put. All right. The underlying asset is right here. You can see that underlying asset. That's short stock. You can see the put has that limited risk. And if the underlying does drop, you make money. Pretty simple. Pretty simple. All right. All right. Any questions on kind of the basics of owning a put or owning a call? I don't understand the graph with all the colored lines. All right. I don't, well, I will gladly walk you through. So, this checkmarked line is the same as being short stock. This represents selling 100 shares of stock shorted. Oh, he means on my live vol chart. All right. Well, I'll talk about the live vol chart later. All right. And then there is your long put. All right. Except for protection, why buy options instead of stock? I'll talk about that, Tamara. Are the dividends you would pay on the short stock priced into the put? Yes, they are. That is a part of the formula. So, however, it's not all the dividends. It's the delta of the option that determines how much the dividend is priced in. All right. And by the time I'm done here, so you should never want to own stocks again. All right. Selling options. Options can also be sold instead of bought. This is called writing the option or writing. In the case of the call, the trader is selling the right to purchase to someone else. And that should say R-I-G-H-T. I understand that. Right. I'm a math guy, not a grammar guy. Cut me some slack here. All right. So in the case of the call, the trader is selling the right to purchase to someone else. In the case of the put, one is selling the right to sell to someone else. So think about this. You're selling to someone the right to sell you a stock. Or you are selling to someone the right to buy a stock from you. Happens all of the time. All right. If anybody, anybody ever trade when on their energy, do kind of the prepay energy deal? You've basically bought a call. All right. Or sold a put. One of those two. Anyway, yeah, so the nice thing is it's an obligation. All right. So when you sell an option, you have no choice but to take delivery. When you buy an option, you are forced. No one can make you. Can you get assigned during the life of the option or only at expiration? All right, during the life of the option, you can theoretically get assigned at any given time. All right, assuming that it's on an equity. All right, if it's on an index in what's called a European style option, it is only at expiration. But for the most part, unless there is a dividend, you will rarely get assigned on calls, and unless the put is deeply in the money, you will rarely get assigned on puts prior to expiration. All right, almost no options end up getting exercised. All right, it is very rare for a call option or put option to be exercised early. All right, the risk associated with that is either because of a dividend, or the put is deeply in the money. All right, or the stock is hard to borrow. All right, so if the stock isn't hard to borrow, the stock doesn't have a dividend, or the put isn't deeply in the money, you are extremely unlikely to be assigned. All right. So the key is, unlike the owner of an option, the seller does not have own rights. The seller has obligations. All right. If a holder of XYZ GN50 put decides to exercise his or her rights to sell the underlying, the trader that sold is short that put will be forced to purchase XYZ for $50 a share. Now, that's oversimplified. There's a kind of, if there was only two traders in that trade, that would be the case. So for instance, in an over-the-counter trade. But in a large stock, there's actually a wheel that randomly assigns people. All right. If a holder of the XYZ GN50 calls decides to exercise his or her rights, all right, how would you know if the stock was hard to borrow? Your brokerage platform should tell you. All right. If a holder of the XYZ GN50 calls decides to exercise his or her rights to buy the underlying, the trader that sold the XYZ 50 calls will be forced to sell XYZ at $50 a share. right? Plain and simple. All right. This is what a short call looks like. All right, you can see the strike price is right here. All right. And the short call, you keep the profit below the strike price, and above the strike price, you start to lose money. Your break even is the strike price plus the amount of premium you collected. I am not a big proponent of call selling. I've seen too many stocks get tanked, or just tank higher, run way up. The short put, very similar. All right. You collect premium that you keep as long as it ends up above the strike price. All right. And if it drops, no call spreads. Call spreads are different than short calls. All right. And below the strike price, you take delivery. All right, so a couple of good questions. Even against shares. Now, against shares, which I'm not going to dig into too much today. Against shares, wrong one. Against shares, if I'm long the call here, what happens is above the strike price, the P&Ls cancel out. It's otherwise known as a covered call. So you won't make any more money, but you don't lose money. However, below the strike price, you can lose money. Okay? Very simple. And in fact, without getting too into details, a covered call has the exact same payout, all right, minus a couple on a risk graph, all right. It has almost the exact same payout as a short put. All right. I like to enhance dividends by selling calls at prices I would sell a stock. I think that's a brilliant way to trade covered calls. All right, that's smart. Now, stocks, calls, and puts. One thing that is important, and I'm not going to dig too deep into this, all right, is that all of these positions, stock, calls, and puts, can be used to recreate all sorts of underlying positions. All right. So additionally, with use of the underlying, you can convert all sorts of trades. And I'm going to show you one convert that is going to blow you, that you guys are going to love. So why combine calls and puts together with stock? And the answer is simple put-call parity. And this is the one thing to be aware of. And this is what holds our universe together. You know, they just discovered those gravitational waves in space, right? All right. The gravitational waves in space version of that, you know, the thing that holds everything we do together is this formula. And even if you never use this formula, having a strong understanding of it will make everything else that you ever learn about options easier. This single formula, having a strong basis in the very basics, makes everything easier. Everything. All right? It's just like every other profession that you do. All right? I'm sure we've got carpenters and plumbers and electricians and pilots and engineers. All right? And at some point there's some and at some level, all right? And at some level there's a couple of real important fundamental things that everything they learn is built off of. This is that. Put call parity. Call minus put equals the stock minus the strike plus interest minus dividends. All right. So I'll quickly run back. I want to take everybody's time up to my Goldman trade. All right. So we know we're going to calculate what the dividend is. So my call is 1650 or 1665. My put is 1715. And that's going to equal, we'll say 151 minus 150 plus, and then the thing I don't know is my carrying cost. And that's carrying cost. That's going to be my C. C. All right, so if I just do basic algebra, right? Negative 0.5 equals 1 plus C. Now, how many of you math majors can figure out what the carrying cost is between now and January of 2017? $1.50. It's actually a negative $1.50. Right. You know what? What is that negative $1.50? What do you think that is? What does that represent? That's correct. The dividend. So the market is pricing at $1.50 in dividends between now and January expiration for Goldman Sachs. All right. But, you know, we can calculate that, we can use this formula to do all sorts of things. All right. So start playing with this formula if you've never looked at it. Start looking at an options screen. You know, I'll quickly just pull up one. Here we go. Here's Apple. And I can even just look at, you know, these expire on Friday. All right, and I can kind of look at my at the money theoretical. All right, and if you look, the February 98 calls are 78 cents. The stock is trading 98.12. So 98 plus 78 is 98.78. All right. All right, 98.78 minus 98.12. It's going to be 66 cents. And my Feb puts are 71. So they're saying there's a nickel of carry between now and expiration. That seems a little off, but that's the way it's pricing itself. Must be hard to borrow. If I buy Goldman Sachs put and Goldman Sachs declares a special dividend of $5 a share, do I hit the jackpot? No, you do not, because special dividends are automatically adjusted out of the stock, out of the options price. Only regular dividends are priced in. All right, we'll keep going. What about when a stock does not go down post-ex dividend? That's very rare. All right, so now let's talk about how and does anybody have any questions on how calls and puts are related, and how calls and puts work in a simplified form? A call is a put and a put is a call. Once you have the stock in, yes. And up until like the minute of expiration, then there no longer are. All right, so let's talk about stocks and options. An option is derivative of a stock. This means that much of its price is directly related to movement in the underlying. How two instruments move with one another is called correlation. The higher the correlation, the more closely tied at the hip the stock and its option contract will be. The way an options price will move with the underlying, its correlation. When computing, all right. The way an option, its correlation is called delta. All right. In option traders, call correlation delta. All right. Why? I think because it sounds cooler than correlation. That's my theory. All right. A positive delta will move just like the stock. When the underlying rallies, the option makes money. All right. When the underlying falls, the option loses money. A negative delta will move opposite of a stock. When the underlying rallies, the option will lose money. And when the underlying falls, the option will make money. Pretty simple. All right. So there are really three definitions we use for delta. All right. Change in the option price with a $1 move in the underlying. That's that correlation. A hedge ratio, which is more for the professionals. So that's how many shares of a $100 lot of stock that particular option will hedge. And then we also use it as a loose percentage chance that an option finishes in the money. So think about it this way, though, at its end. Delta is an option's sensitivity to a stock's price directional movement. All right. Delta measures directional exposure. Delta has a range of -1 to +1. Options with negative deltas negatively correlate to the underlying. Options with positive deltas positively correlate with the underlying. All right. The closer the delta is to 1, the more it correlates positively or negatively with movement in the underlying. Calls have a positive delta. Buying a call is long delta. Selling a call is short delta. Puts have negative delta. Buying a put is going short delta. Selling a put is going long delta. But the idea that these two, buying a call and selling a put, they're long delta but very different positions. Same thing here. These two positions are short delta, but they act very differently. All right. Understand how moneyness works. All right. So now understand how moneyness works. All right. In the money means that the option is, the call option is at a strike price well below where the stock is currently trading. All right. At the money, it leaves a big margin for error to some degree. At the money is options that are right near where the underlying is trading. So in XYZ, if XYZ is trading $50, then that $50 call is an at the money call. And then out of the money are options that are way, way, way far away from where the underlying is trading. All right. So in the money needs the option to move in the right direction. At the money wants the underlying to move in the right direction, but has a big exposure to other factors like volatility. And out of the money wants that go, go, go action. All right. So now leverage in delta. All right, 100 shares of a $100 stock is going to cost you 10 grand, or on Reg T margin is going to cost you 5,000 bucks. The position delivers 100 deltas, so 100. So you make 100 bucks for every 1 point in the underlying for $10,000 in exposure. For every point the underlying rallies, the position will make 100 bucks. I can create similar positions with options without laying out the same capital. All right. Alternatively, we can lay out similar capital but create less risk. So let's look at Apple. Anybody here ever heard of Apple? Apple is trading 98 bucks a share. So the purchase of 100 shares cost $9,800. Let's look at a call strip, so a bunch of calls in March, and discuss ways to create a similar 100 share exposure. We'll examine moneyness as it relates to the creation of 100 shares. All right. So let's just look at what we got here. All right. I could purchase an 80 call. All right, that's going to give me exposure of about 100. So one call recreates Apple. All right, and you can see the cost is about $18.25. This Theo number I'm looking at. All right. Or my next option, I could buy my next option for options. That's funny, Scott. I just saw that. Next, I could buy the 97.5 call. That costs $3.25. Each call is 55 deltas of exposure. So I would need 2 calls to create proper exposure. So 2 of these calls. That's right here. All right. Now my final option, I could buy the 110 calls for 20 cents. That's right here. 20 cents creates about 6 deltas of exposure. So I need 17 of these to create the proper exposure. Right? So 17 times 6 is about 100. So notice each of these, the higher up in the money to out of the at the money to out of the money, the more options I need, and the more my exposure changes. So as I get deeper in the money, other variables that can affect the option's price start to dissipate, and my position becomes a total stock replacement. The only advantage of buying that in the money option, I can lose that $1,825, but it kind of sets a floor in. And if it goes up, I participate 1 for 1. And this is the biggie. Look at the cost. It's call it 1/6 of the cost of buying the stock. Even with even on Reg T, it's 1/3 of the cost. As I get further out of the money, other variables become important. While the 110 calls for 20 cents are cheap, they only cost $340. There are other factors that can make these calls worthless, most notably Apple going nowhere. So I'm a big Villanova basketball fan. Anybody here ever heard of Villanova? What is Reg T? It's a margining on stock where the charge is 50 cents for every dollar owned. Now, Villanova's had a rough tournament run the last few years, but they are currently #1 in the nation, and I think they're beating up on Temple right now. At least I hope so. They were at the half, and then I had to start teaching you guys. So if anybody wants to update me on the Nova Temple score, they're on ESPN too. So all right. So now let's look at what the problem is. So the returns on stock on a $2 move, I make about $200, and that's on $9,800. 2%. On my in the money call on a $2 rally, I make 10%. On my at the money, I make 33%. Thank you. My out of the money, I make about 67%, 66%. All right. Now you're saying, Mark, you can lose that much too. But remember, I've got all that extra cash that I didn't have to use. Successively, each of these ties up less capital. All right. So what's the catch? And the answer is time. All right. Each of these trades has a shot clock. Get the basketball reference now? All right. If the stock doesn't move quickly, each trade loses eventually, except the stock. All right. My 80 calls lose about $25. Right? Time is the master. My 97.5 calls lose about $400. So I can lose $25. I can lose about, call it 400 or maybe 300, something like that, if it sits. And I can lose 100% of this. Now let me look at where is my apples. Apples trading 98.12, yeah. All right. So every option has a shot clock. So here's the way I want you to think about in the money, at the money, and out of the money. All right. All right. So in the money options have a full 24 seconds. All right. They are good up until the last minute of expiration to make the trader money. I mean, literally, if Apple sits for weeks and weeks and weeks and then rallies a buck at the end, all right, it's just the stock minus so someone want to know how I calculate this. So all I did was I said that, if Apple's trading 98 bucks, all right, my 1825s are 80. So here, let me clear this out. This is a good question. All right. So in the money call, my call is 80 plus my $18.25 minus 98. I've got 25 bucks to give up by expiration. All right. And my at the money call, those are 50 cents in the money. So it's really, because these are 97 and a halves. So it's 97 and a half plus 325 minus 98. And then these are way out of the money. And so they basically go worthless. So I want you to think about the shot clock. All right, at the money options are kind of like the foul, the touch foul where you get 15 seconds back on the clock. All right, so it's a 15-second inbound pass. If the stock moves in a reasonable amount of time, you've got plenty of time to run a play. Right, it's 24-second clock. You've got all day. You can run your full set of plays. Every option's on the table. All right, you're at the money. You've got time to figure out what play you want to do and run it. All right, you're out of the money option is like 1 second left from beyond the arc. If the stock doesn't make a big shot now, it's over. Thanks, Rick. I love it. So that is how this all works. All right, so in the money, you got up until expiration. At the money, you've got till about the week of expiration. Out of the money, it better move in the next couple of days. So now you're saying, well, Mark, what if I go further back in time? Awesome. All right, that's awesome. So when you're creating a trade, the trade-off between time is cost and exposure. While the trade will have more time to work, it will take longer to profit on a strike-by-strike basis generally, and it will definitely cost more. All right, so let's look at the Apple strip from this coming summer, and I want you to immediately notice, look at my 80 calls. They've lost 12 deltas of exposure. All right, now in order to recreate 6 deltas of exposure, I'm now talking about the 130 call instead of the 110 call. If I want to buy a 110 call, look at this. And just ignore this. Oop. Ignore this. All right. My 110 call now costs me $2.80. Almost as much as my 97.5 calls did in March. Am I at the monies? Well, they're double the value. So yeah, if I want similar exposure on out of the money, I have to buy a lot further out of the money, and guess what? It still costs more. My 6 delta call is 40 cents and 20 more dollars away. My at the money, similar delta exposure, but it costs twice as much. And my in the money costs just a little more, So only an extra buck, but I lose 12 deltas of exposure. Okay? So there is a trade-off. All right? There is a trade-off on how you trade this stuff. All right? If you want to add to your shot clock, it's going to cost you money. So think about going out of time as instead of a 24-second shot clock, you've got several possessions to play. Let's just say possessions. So how do you decide? Well, we'll talk about that at the end. All right? And we're going to talk about how to decide these different pieces, actually right now. All right? However, the same holds true for out-of-the-money options. They want the move to be somewhat closer in time of the trade. In the money and at-the-money options have a lot more time to work. So now let's talk about how to build the long trade. If one thinks the move will be short and only a matter of points, all right, on a trade, what should one trade? What if one thinks the move will be violent and short? What should one trade? If one is trading stocks in a day trade or for a small near-term move, in the money options are going to be the right way to play, and you want short dated. All you're looking for is margin relief. If one is looking for near-term violent move, violent, you want at-the-money options, even if out-of-the-money options seem cheap. And if you're thinking about buying out-of-the-money options, you need basically a nuclear event, a LinkedIn earnings type of event. You know, a Chipotle event. That is what you are looking for. If you're going further out, and I'm looking at duration, you want to buy out-of-the-money options. It's generally smarter to buy further out. I'd rather buy the 110 calls for 270 than the 110 calls for 20 cents. While a 90 to 120-day call that is well out of the money may cost as much as a near-term at-the-money option, it will actually gain value with the rally in the underlying. It works. If one is looking for a slower long-term move, don't buy in the money, buy at the money. All right? And if one is looking for a quick move, but they're not sure when, they think it's going to go up pretty quickly, that's when you go out of the money longer term. So if you're expecting a stock to go on a longer run of a couple of weeks or a month, go buy a 90-day out of the money option. If you're expecting a call to move slowly higher for the next month or 2 months or 3 months, buy an at the money option. For longer term plays, you start to lose some of the value of the leveraging. I don't like in the money options in the leaps. It's not the most efficient way to trade at all. Buying puts. Buying puts can be even better for day traders. This is because the leveraging costs of being short stock are so much higher than the leveraging costs of owning stock. Now, unlike calls, at the money puts tend to perform well even on short-term small moves. And this is because of a factor called vega, which is that exposure to implied volatility. But the same principles of the shot clock apply to puts. However, this is the one thing to be aware of. Supply and demand. They change the way out of the money puts work. All right. So what percentage of the world is naturally long stocks? Almost all of them. What percentage is short? Very few. And what it does, it creates this moneyness volatility curve, or called moneyness cost curve. And what do you notice? Here are puts. Here are calls. What costs more? Out of the money calls or out of the money puts? Puts, absolutely. Generally speaking, unless you know a down move is going to happen, stick to options that are somewhat close to the money if you want to go short by purchasing puts. Okay? Now, selling options. When selling options, one can use them to their advantage, especially puts. I'm not going to talk about covered call writing today. There are many good reasons to sell calls. However, we've got very limited time, so I want to stick to puts today so I can get to the subject I really want to talk about. Creating a long delta by selling puts. If Apple is trading for 98 bucks and I sell the out of the money 90 put in July at 4 to a hedger, what happens? Remember, I'm giving someone else the right to buy, but not the obligation to sell me the stock at 90. All right, so they're getting the right to sell me the stock at 90. Well, let's look at our payoff. So if Apple sits or rallies, I will not be assigned and I keep the $4 that I sold. If Apple falls but stays above $90, I will probably not be assigned the stock and I keep my $4. If Apple falls below 90 but stays above 86, right, 90 minus 4, I make money, but I will take delivery. And if Apple falls below 86, that should say 86, I will probably take delivery and I will lose money. But that is okay. There are a lot of people that only sell puts in stocks they like, hoping to take delivery. But what if the stock just goes up and up and up? All right, what if you like a stock and it just goes up and up and up? Think about Apple circa 2012. What's the problem? You don't participate in upside. Remember, here's our put graph, right? You're safe all the way down to where you collected premium and above and all the way up to about here. You're doing better than owning the stock. However, the stock can keep going and your put stops. So what do? How do you turn this into a trade? And I'm going to show you why you're never going to want to own a stock again. Remember that supply and demand chart we looked at earlier. What do you notice about cost? Even better, the risk reversal. What if I sold an out of the money put and bought an out of the money call at the same time? So Apple's trading about 98.5. All right. 98, whatever. All right. So my calls are, 98.5, right in between. So my calls that are, let's say, 11.5 bucks out of the money are $2.80. My puts that are 11.5 bucks or so out of the money are trading $3.50, or $2.80 versus $3.50. All right. What is a debit of 280 plus a credit of 350? I collect 70 cents on this spread. Yeah, it's a 70-cent credit. And what does this look like? Well, let me show you. As you can see, on a 10 lot, this is a 10 lot. On this spread, I create about half of 1,000 shares of stock. As it rallies and falls, my exposure moves toward that one again. But take a look. So this blue line is June. What do you notice? Notice that blue is actually over where the green, which is April, and the red, which is February, are trading. That's right. So as long as Apple stays above 86.80, I keep the 70 cents. And if it rallies, I participate. Isn't there a margin requirement on a short put? There is. All right. The margin requirement on a short put is similar to Reg T. So the margin requirement on this position is going to be about $8,600. But if nothing happens, I make money. And if the underlying rallies, I make money. And if the underlying falls some, I don't have to lose. All right, now let's look at a little more aggressive play. All right, what if I did the July 97.5, July par, risky? I pay $630 and collect a credit of $730. And I use those numbers for simplicity. I collect $1. So if Apple stays above $96.50, all right. So if Apple stays above $96.50, I win. And look at my exposure now. So look at my exposure. I have what amounts to a delta 1. I have the exact same delta exposure as long stock. Same everything. But lo and behold, I have a credit. If time passes and Apple doesn't do much, I make money. If Apple rallies, I am off to the races. This trade is called a risk reversal. The risk reversal is a total stock replacement system. It creates a credit to the trade, thus if the stock goes nowhere, the trader keeps the credit. If the stock drops, the trader can collect the credit, potentially, and will own the stock at a discount on delivery. If the stock rallies, the trader will have participation. It's the best of everything. Risk control. The next step is to learn to spread. By spreading, I can take even more risk off these delta-created positions. If one is handling a standard position, one must have a defined risk parameters in the trade. These positions can have similar position P&Ls to stock trading. Take the same approach. The next steps for you are covered calls, wheel trading, understanding volatility and other price drivers, the Greeks, debit and credit spreads, and complex spreads. Now, I will do a scan as soon as I make my little offer here. So starting February 24th, so a week from today, I'm doing a beginner boot camp. If you learned a lot today, If you learned a little today, if you learned medium today, this camp is for you. All right? It is normally $400. Through Monday, $247. I'm going to teach you to understand more of the basics of options. I'm going to teach you to integrate stock and volatility charts. We're going to learn volatility trading. I'm going to teach you to sell puts, sell calls, create stocks, and create stocks for profits. We're going to talk about increasing profitability on directional trades via spreads. And I'm going to teach you more about profiting and awesome, thank you. More about profiting and minimizing risk. Now, to the next 200 traders that sign up, use code 25_off, and you can take an extra $25 off. In addition, if you sign up by Monday, I will give you the silver course, which is the next level after the beginner boot camp, for free. So you don't even just get level 1, you get the next step up, which is 2, our silver course, for free. So this will take you all the way. And we're talking, the boot camp's going to be 8 hours, the silver course is 6. So we're talking 14 hours of education. I'm sorry, the boot camp is going to be 7 hours, and the silver course is 7 hours. 14 hours of education for $240. It is going to be done online. You go to optionpit.com/begincamp. It starts the 24th, next Wednesday, and it starts at 6 Eastern Time. You go to optionpit.com/begincamp. Now, if this was rudimentary for you, on our classes page, you can find our standard boot camp. All right, now, you guys wanted some any questions about any of this? How does someone in MST who works do this? We're going to record all of it, and you will have access to the recordings for life. I'm not looking at you at VXY for this group, Judy. What are your thoughts about selling monthly calls and buying 12-month protected puts to reduce the cost of monthly insurance? Not a bad idea at all, still. I thought, well, I just did. You can day trade using these risk reversals. What is the best leap for calls? I like more at the money for leaps. And really, for leaps, I'm typically looking to sell puts. Does the call offset the margin on the short put on your last example? No, it does not. So all of the margining on that is the put. But you can create what's called a put spread. So what I could do, and we're going to teach this in the beginner boot camp, is sell the 97.5 and buy an 80, and that will reduce the margin. So something like this will reduce the cost. What about wash sales on options? You don't really have to worry about that as much as long as you're not trading in and out of the same contract over and over again. You're allowed to roll. Do you use risk reversals primarily for non-dividend paying stocks? Yes. Yes, I do sell put spreads to not tie up as much buying power. So a trade like this is going to have a lot less margin cost. Only about $1,700 a spread. Yes, it is better to buy hard deltas. As in, don't use risk reversals on dividend payers. You can just be aware of when those dividends are and be aware whether you're going to get signed on the stock or whether you need to exercise your call. So for day trading, would you do spreads like sell a put and buy a call? Yes. I do that all the time. Or simply buying in the money call instead of the stock, and then you can tie up less margin. All right, so let me just show you how I might scan for a trade. I'm going to switch screens here, folks. I'm going to push the recording out. So let me just show you some stuff that I look at. So I'm always looking for stuff where the premiums are crashing. Now, nothing crazy here today. ADT is getting bought out. All right, but I will look for imploding. Priceline was up $125 today. Thank you. Yeah, I'm excited. Go Nova. They must have had earnings. Did they have earnings today? Yeah, they did. All right. So here's Priceline. This, what I might look at. All right, so I love stocks that just blew up on earnings. All right, so you can see it got hammered, popped. All right, it's now back at its 200-day moving average. So we'll look at this. So it's now back at its 200-day moving average, well above the 50, and it had a breakout. All right, now it looks like it wants to get back to $1,300. All right, so if you learned a lot on this, you should absolutely take the beginner boot camp. So it looks like it wants to go to $1,300. So I think that this is more of a short-term play. And I'm looking for a $65 move, let's say by the end of next week. All right, so I can buy 100 shares for $1,200. That seems expensive. Or I can look for something that'll give me that exposure. So look at this. I would be looking at buying. I'm going to look at my little demand curve. Oop, wrong one. Look at my demand curve. And I'm going to look and see where is demand inexpensive. And I'm going to look at those 1250 calls. So what I might do is look at the 1250 calls that I was just looking at, believe it or not. I don't know why my eye was drawn to those. And I would buy a couple of those. These are the calls I'd be looking for in Priceline. I'm glad you like the shot clock analogy. Now, if I don't want to take all that margin exposure, or I don't want to risk dollars, well, guess what? Priceline I can get 20 bucks away and put on my put risk reversal if I want to put the stock on. And here, I'm getting almost 100 delta of exposure, and I'm not paying anything for it. Or I'm paying, a small amount. This is called Live Vol X, and this is my platform I use to trade. My clients get special pricing too, which is nice. All right, and then when I pull this up on my risk chart, you can see over the next 8 days, move this to the 19th, you can see how this thing forms. See, I've got a little premium that I'm collecting here. Or imploding ones. I love buying calls in imploding vol after a big move. So I like the fact that it's up big today and implied volatility is really down. This is more of a naked call buy for me. In fact, I may do this tomorrow. All right. Oh, So that's kind of my plan. But obviously, you know, this is just for education. Do what you think you do. I run a hedge fund, Rick. So why are you bullish after such a large gap up? I just kind of talked about it. I'm more of a vol guy though, Rick. I'm not a directional day trader. I run volatility. Do you sell puts in 52-week high IV names? No, I don't typically. So I think that the fact that it broke over its 200-day moving average is a big deal on this gap, especially in this crappy market that we're in. So, all right, guys. On that note, it's 8:20, 9:20 Eastern. It's getting late. Let's let everybody go. But I wanted to kind of show you some things that I look at. I love looking for imploding premiums. All right, and stocks that are gapping big. All right, those are things I look for. All right, everybody. Remember, go to optionpit.com/begincamp, and I hope everybody has a great day, and I'll have this posted tomorrow. Have a good one.